Something important is being missed in the silver market right now, and it starts with the growing disconnect between price action and interpretation. Just as silver begins to escape a range that held it captive for decades, the loudest voices are suddenly calling for exits, warning that the move has gone too far. Michael Oliverc cuts directly through that noise, arguing that this is exactly how major transitions begin, not with comfort, but with disbelief. When an asset leaves an old reality behind, it doesn't ask permission, and it doesn't wait for consensus. For nearly 50 years, silver moved sideways while other commodities and monetary assets repriced again and again. That wasn't stability. It was suppression through distorted assumptions. Similar patterns appeared in markets like copper and lead, both of which spent decades trapped before repricing violently in a matter of quarters and never returning to their former ranges. Silver is now displaying the same characteristics, not only in absolute terms, but in its relationship to gold. Even after a sharp relative move higher, silver remains historically cheap, a signal that the adjustment is incomplete, not finished. What makes this moment more dangerous is the broader financial backdrop. This is not a speculative cycle driven by excess optimism. It's unfolding against rising stress in sovereign debt markets, where long-term yields refuse to cooperate despite policy efforts. That tension points toward forced intervention, not gradual reform. When bond markets begin to wobble, liquidity doesn't trickle, it floods. Precious metals historically respond before those actions become obvious, not after they are announced. The mistake many are making is treating this like a familiar pattern that can be traded casually. Silver is no longer behaving like a volatile sidekick to gold. It's redefining its role as monetary pressure builds beneath the system. When that realization becomes widespread, the repricing won't feel orderly or reasonable. It will feel sudden, uncomfortable, and irreversible, exactly how real transitions tend to unfold. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
I think our assessment is that there will be a correction in the middle of this move. Now, how do we define when this move began? It's when the spread relationship between silver and gold broke out. Now, already gold and silver have been going up for a couple of years. Okay, no big deal. So it's not like they suddenly became bull markets. But back in November, when you divided the price of an ounce of silver and an ounce of gold, it cleared a massive ceiling of prior resistance on that relative performance chart, on the spread chart. So when you plotted silver versus gold and went back like 10 years, you'll find, oh, it keeps stopping at this level, keeps stopping at this level. Very shallow level, by the way, but a technically definable ceiling. When we closed above that in November, we announced, okay, the same event, technical type signal occurred in 1979, just prior to silver gushing from like 15 bucks to 50 in 5 months. Think of the percentage gain there. And in September 2010 through April 2011, it went from 20 to 50 in 7 months, either side of 2 quarters. So once that unleashing occurred, where silver said, no more, I'm going to seek a fair value to gold, that's when the price gush really occurred in silver. Oh yeah, gold kept going up all during that time. It wasn't an issue of gold going down, silver going up. It never is. Silver exploded versus gold, but it did it in a couple quarters. And we found other ends, like I mentioned, copper and lead, for example, when they took out those price ranges. When did they accomplish the meteoric move? In a couple quarters. Not 3 years, not incremental, but vertically. I think that's where we are. In which case, the clock just began starting December is month 1, January's month 2. Okay, we're 2 months into a probable couple quarter surge. But in each of those cases, and probably in this one, there will be a midpoint about in the middle of that time clock, not in the middle of the price move, okay, that you'll get a shin kick that doesn't just last a day or two, but maybe you get kicked and you don't make a new high for 4 weeks or so. In other words, what you could call a correction or at least a solid stall. So far, you'll notice in this past 4 or 5 days, we've had 2 12% collapses in silver from traded high to low, usually within hours. just like today, 121 to 106.90, bam, like that. And all of a sudden, you close out the week around 114, 115. Solid up week, massive up week. And as far as the month goes, with the day left, we closed last month at 70. Think about it. Let's say we closed the month here, 115, and people are complaining it's topping. Give it a chance, And we think probably, yes, there will be a midpoint correction, but we're urging our subscribers that when we try to identify that, and maybe we'll try, don't even apply it to your investment positions, because you could mess yourself up pretty badly in terms of getting out. Because then when you get back in, instead, if you're heavily in calls or time or leverage positions, then maybe you should act on that correction thing. But in both of those run-ups in 79 to 80 and 2010 to 11, once you had that correction in the middle of both of those, what was on the other side was even more than what had happened up to that point. So you get the point. Just screw your head on, right? If you think gold's going a lot higher, and I think it is, because this time we don't have the kind of situations we had in 1980 or 2011 in terms of the macro fundamentals of monetary metals. We have a government debt crisis, not a mortgage crisis, not a dot-com bubble. We've got a government bond crisis. And everybody knows we got one in Japan, but we got one too. And back in November, I probably said this before to you, President Williams of the New York Fed said, the Fed's going to start buying bonds, quote unquote, okay? But he said the reason was to provide liquidity. That's cute. Okay, what they're trying to do is support that market. And if you look at long-term bond futures, 30-year bond futures, right now they're trading 114, 115 area on price, 114, 115. And yields are holding at high levels and price is holding at low levels for 3 years now. So they can cut short-term rates all they want. It hasn't affected the long end. And there's a lot of companies out there, especially in commercial real estate, and some banks are vulnerable to this choking high yield, high rates. It's not coming down. And the T-bond market itself doesn't look good. It doesn't look healthy. Our technical analysis of the T-bond market says, and it's bigger than the stock market, by the way, you don't want to slip about 3 more points from the recent lows we've seen in T-bond futures. And by the way, since they started buying in November, T-bonds have come down in price, up in yield. So it hasn't helped stabilize that market. May have slowed its decline, but it hasn't stopped it. You drop about, 3 points below where you are now in prices, and you're gonna spark a sharp sell-off, a rise in yields. And that's gonna panic the central bank, because then all of a sudden there could be a global perception that, yeah, we know all the Western world government bond markets are not in good shape, and Japan's in a panic mode. And if all of a sudden another one looks like it's not only not in good shape, but looking like, it's very risky, then suddenly you get arms in the air. And what's the alternative? Well, Morgan Stanley said so a couple months ago. You know that. It's almost worth a chuckle. Instead of the 60%, 40% bonds, 60% stock portfolio balanced, so-called, it's now 60, 20, 20. Gold is 20. Okay. Heck of an admission, but a good admission that the old reality doesn't work anymore. Bonds are not the alternative. In fact, the only thing wrong with his statement was the balance percentages. But anyway, that's where we stand now. So we have you've got to watch the government bond market, because that's a potential crisis beyond any. That's a nuclear event, and it's dancing on glass. And we're arguing technically you drop about 3 more points in the bond futures. And I suspect they're going to do it. Question is when. This month, next month, or the following month. I think soon they probably will. You're going to have a noisy panic. The central bank will go berserk in terms of, print. They got to save that market. They can't let it catch fire. And the public can't take it in terms of, sense of stability, And that's what's helping drive gold, because I think it knows it's coming.
Volatility is no longer a side effect in silver. It's the signal. Sharp drops, violent rebounds, and wide intraday swings are not signs of exhaustion. They're signs of transition. Michael Oliverc points out that once an asset leaves a long-held range, it rarely moves in a straight line. It lurches. It shakes people out. It creates fear in both directions. Silver trading well above past ceilings, then snapping lower and recovering just as fast isn't weakness. It's the market struggling to reprice something it kept misvalued for decades. What changed wasn't momentum, it was relationship. When silver finally broke out relative to gold, it marked the start of a different phase, not the end of a move. That same relative shift has historically triggered short, explosive windows where prices don't grind higher over years, but surge over months. Those windows always include mid-cycle stalls and brutal pullbacks that feel convincing enough to force people out. Yet each time, the move that followed was larger than everything that came before it. That's why Oliver stresses that corrections inside a repricing phase are not exits, they're pressure tests. This is where expectations become dangerous. People anchor to old ranges, old ceilings, old highs, and assume gravity will pull price back into familiar territory. But once a market enters a new reality, the old map stops working. Oliver argues that silver isn't aiming for comfort, it's seeking balance, and that balance historically lands far above what feels reasonable. Levels that once sounded extreme begin to look transitional, not final. In that context, volatility isn't something to fear. It's how markets cleared disbelief on the way to prices few were psychologically prepared to accept, including scenarios where silver eventually trades in ranges once dismissed as impossible.
There's a whole bunch of both technical, price-based history, behavior of some other markets similar to what silver's doing now, which is a rare event, by the way. What silver's doing now is not a normal bull market. And so people who are applying the normal metrics like, oh, it's overbought, et cetera, throw it out the window. This is different. This is not a normal bull market. We're in something bigger, not just the fundamentals of silver particularly, but the fundamentals of monetary metals. The technicals for silver are unique, and they're going to get corrected meaning to the upside. Silver's vastly underpriced to gold historically. It's now resurrecting itself, and it's going to do it rapidly. We suspect that much of what you're going to see will be accomplished by, let's say, early summer. So let's say early third quarter. At that point, we would get more cautious about it, but I strongly suspect you're going to see the price of silver not just at 200, but probably 3 to 5. Okay, now there's reasons for that, but we can get into them if you want to. But my main message to people is now, yeah, it's been great to come up to here, but it's trivial. Silver's in a move to a new reality. Treat it as such. Tim Cramer on CNBC says, sell it, it's overdone. Okay. Therefore, we know it must be true. Again, don't apply old norms to silver. This is different this time. Silver has been, I'll throw out a couple of examples. These are just price-based, not our momentum work, but it's in-your-face type historical data. As silver has stayed confined in a 50-year range up until like 2 months ago, up and down, between $4 and 50 and so forth and so on. Nice dimensions. I mean, it was a tenfold move from the bottom of that range to the top, and the bottom of the range to the top. But why was it confined? 50 years. Gold wasn't confined. It made a high in 1980, took it out vastly in 2011, and took that high out again. You can even look at copper and go back to 70s, 80s, 90s, 2000, up through about late 2005. Copper had been in a lethargic old reality of 50 cents to $1.50, 50 cents to $1.50 a pound. Up and down, up and down. That was its reality. But in 2005, late that year, it broke out above that. I'm talking just simple price now. And in a couple quarters, it had fourfolded up above $4. Okay, boom, like that. It didn't take 2 years to get up there. But it said, hey, I don't belong in this old reality. Certain things have changed. I mean, you can throw out one of the major things that's changed constantly is the decay of the money in it, the buying power of the U.S. dollar. You look at the quantity of dollars created every decade, and it's sure enough, that's why a loaf of bread used to cost 20 cents, and now it doesn't, okay? So copper said, no, I'm going to a new reality, and it did it in a couple quarters. And then you look at lead, which was in the same type of situation as copper for multiple decades, just up, down, and in this definable old reality. And in 2007, year and a half after copper had done its thing, lead broke out. And again, like quadrupled in a couple quarters to a new reality. And after that new reality was reached, it sold off some, but it stayed in the higher reality than had been the old one. Same with copper. Okay. And then you look at gold, the mama monetary metal, and it hasn't been contained in a range. In fact, its bear market lows to bull market highs have been eightfold moves, 1976 to 1980, 2001, 2002, up to 2011, an eightfold move, multiple gain. Right now, we're only fivefold. So right now, even gold hasn't matched the dimensions, but it wasn't confined in a box. It was higher highs. Okay. Silver finally says, me too. Okay. But when you value silver versus gold, do a simple thing. Divide an ounce of silver into ounce of gold, and plot that. And early last year, it was down at 1%. Ounce of silver to an ounce of gold. That's like free. Okay, historically very cheap. And now it's up above 2. That's a major move. That's a doubling in the relative value of silver to gold. But it's still cheap at 2% plus. Because if you go back and look at the price range for 50 years, 2 peaks at $50. But look at the spread range. Where was silver in 1980 versus gold? 6.5%. And then in the surge in 2011, when it again reached $50, it was 3.1%, the price of gold. Right now, we're still 2%. We're still cheap. So it's our working assumption that don't be surprised, in fact, and expect that not only will silver seek a new price reality, but that its relationship to gold will at least re-achieve those old relationships to gold in terms of relative pricing. In other words, huge gain from here. So as gold continues up, which we think it will, is now in accelerated mode, obviously, silver will be even more so. And there's a lot of other reasons here, but so if you're long, don't look at it as, like 1980 run up or 2011 run up and, got to take those profits because we're going to collapse again.
Looking ahead, the path toward $500 silver would not be driven by hype, but by pressure building quietly across multiple fronts. Structural supply tightness, years of underinvestment in new production, and rising industrial demand tied to energy transition technologies create a backdrop where even modest demand shocks could trigger outsized price responses. At the same time, persistent monetary expansion, growing sovereign debt burdens, and declining confidence in paper-based financial systems increase the appeal of hard assets that cannot be created at will. In such an environment, silver's dual role as both an industrial input and a monetary metal places it in a uniquely explosive position if capital begins rotating defensively. If a revaluation phase unfolds, price discovery would likely occur rapidly rather than gradually. Thin physical inventories, leverage embedded in derivative markets, and a scramble to secure real metal over paper exposure could compress years of price movement into a short window. A move toward $500 would signal not speculation, but a repricing of risk, currency credibility, and real-world scarcity all at once. The key takeaway is that extreme outcomes usually emerge not from a single event, but from long-running imbalances finally reaching a breaking point. Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.